All right, welcome to this webinar where we're going to talk about the Frontier Angel Accelerator. My name is Looney. I run Fledge, the conscious company accelerator based out of Seattle. And my partner is John. This is where you're filling your name.
John Seacrest. What else you want to know?
No, we'll get a little bit more background on you in a bit.
Yeah.
A little bit of housekeeping. So what works best on Zoom is if you stay on mute if you're not speaking, so there's no background noise. But please, all you got to do is press the mute button when you want to chime in, and you can ask questions at any time. When we're not sharing the screen here, when you click on, it gives you a choice. When you click on gallery view, you get a better view of everyone. Whoever's not speaking is going to be watching the chat window. So if you feel like typing in a question, type it in there and someone will notice it. And we are recording this so that anyone else in the world who's interested can join in later. All right, the agenda for the night is nice and quick and simple. I'm going to give a quick overview of what we mean by an angel accelerator, why it's important, why we think it'll help you in your home city. And then John's going to talk about Angel Investing 101. And John, these are the same. And if you're watching the recordings, this is the same as webinar number 2. Same slide, unless you brought new slides.
I was thinking that I would use the Alaska slides since I'm trying to get a little bit out of the Seattle model, and we'll see if those help a little bit.
We'll switch over to your screen for that then.
Yeah, actually, I'll try and send you a copy of those slides. I'm looking for them right now.
I can make you the host, so not a problem.
Okay, all right.
All right, so let's talk about learning angel investing. So going to start at the beginning, and the beginning is what on earth is an angel investor? What do we mean by that? And the definition is rather simple. So anybody who is investing their own money in a startup is an angel investor. The distinction that we make for startup investors is those that are investing their own money are angels, those who are investing other people's money are venture capitalists. Venture capital funds come in lots of different sizes. But the key piece is that it's your own money at risk, therefore you're going to make decisions that are slightly different than fund managers. And anybody can do this within reason. In the countries we're talking to outside the US, anybody can do this who has the money to lose or the money to make or the money to put at risk. And so how do you learn how to do it? And that's where it gets tricky. So the most common way to learn angel investing is to learn from angel investors, to learn from others who have done it before. And it's usually learned in a group. It's usually not learned master apprentice. It's usually not learned by just picking it up on the street. It's usually learned by joining some organization that angels have formed in order to make investments. And when you join one of those groups, there's usually some angels around who have done it before. And you learn by watching what they do and listening what they do and asking questions to them. But what we're going to propose here that works better is an angel accelerator. We'll be using the terms angel accelerator and angel conference a lot today, and they're just considering them the same thing for now. So the reason why angel investing is a group activity, something you need to do in groups, is that you need to learn it by doing it. That you can't learn angel investing by just reading a book about angel investing. You actually have to go out and make investments. You have to learn it from others because it's not one of those topics that's easily just picked up from a book and then applied. This isn't math or reading. And the reason why it's really important to do it within a group is because it's a group activity. Because the first thing you need to do to figure out whether or not you need to make an investment is generally what we call due diligence. You have to understand what the company is who's asking for money. You need to understand who they are, what they're doing, what their market is. And the bigger the group you have that is helping do the due diligence, the more information you get, right? Because everyone who's an angel has different experiences. And the combined experience is much more powerful than any one person. But it's also a group activity because the money that startup is asking for is usually, almost always, more than any one person has or any one person wants to put at risk. And therefore, in order to pool up the money that the angels need, And feel free to chime into the chat window whenever I'm using a word that doesn't sound normal. It sounds like jargon. So we use the term pool money together. And I see something just popped up.
That was me.
Oh, okay. And so in order to get enough money together to invest in a startup, you need a group of investors. And it's easiest if that group of investors already know each other and already trust each other and already trust their due diligence, so that they can simply write a bunch of checks, fund the company, and let it go off on its job, as opposed to they've provided half the money the company needs, and now there's the need to go find yet more angels. So what we're proposing and what we highly suggest is to not only learn this as a group, but to do it in a structured program that whose purpose is to teach angels how to be angel investors, and to do it in a structured program so that so that you're learning the content, you're learning the process in a structured way with the key lessons in a reasonable order, as opposed to just picking them up in whatever order they happen to come across in your group. There's also a really important piece in here, which is that there's plenty of startups to fund, but having access to an adequate amount of deal flow, which is a term of art we use, having enough access to enough good startups is really important to make sure you're making good decisions and investing in good startups, as opposed to whichever 5 or 10 you happen to come across. And in time, by having a structured program, you have graduates of that program who are repeating the process, because you learn by doing over and over again. You learn by iterating. And so over time, there are experienced people within this structure as well as inexperienced. And you're starting to learn from others who have done it before. And we're going to help by bootstrapping this in your home city to bring the knowledge we have from investing here in the States and overseas, so that you're not starting from scratch, so that you're starting from the knowledge that we're bringing. So there's a structure that John has run here in Seattle for 7.5 years. It's called the Seattle Angel Conference. And it's a replication of a program that started in Oregon, the state just south of here. And so overall in all, it's been running for about a decade. There's been 15 sessions run here in Seattle, basically 2 per year, every year for 7.5 years. And the formula is, it's got a lot of dots here, but it's rather simple. So you gather together 20 to 40 investors. And again, nobody has ever had to do this before. And these numbers are the Seattle numbers. We'll be tuning these numbers for your home city. So you gather together a few dozen investors. They each commit to invest some money, and that amount will change from city to city. But here in Seattle, they put up $5,000 a piece plus a little bit of fee to cover the cost of running the program. And so together, they've created an investment pool of $100,000 to $200,000, which is a reasonable amount of money for an early startup in Seattle. In doing that, in creating the pool of capital, they attract startups to this conference. And so 30, 40, 50, 60 companies will apply. The goal is to start out with about 30 investments to choose from. So the angels are providing the capital for this program. The angels are the ones that are choosing which companies are worth investing in. The angels will, in fact, choose the final winner. This pool of capital will go to one company in the end. And the angels are learning how to be angel investors by being angel investors, working together as a group. And so this formula works really well at creating angel investors. So yeah, Ms. Jiang, you have a question? That was a raise hand button. Now you're on mute if you're trying to speak.
No, sorry, I think I pressed something by accident.
Okay. All right, so what this again looks like is a few dozen investors, 20 to 40 investors, and a bunch of companies who get together over the course of a 12-week period, once a week for 12 weeks, where the investors are meeting with these companies face to face. The companies are presenting their ideas, either a minute or 3 minutes or longer. The investors are then chatting with them to to understand how they work, and then chatting with each other to winnow down the list. And they're winnowing down that list to 6. And in the final week, those 6 present on stage for a few minutes each in front of a live audience. The investors then go off and disappear for a while. Typically takes an hour or so. And then they come back and announce which company is the winner. And that company will get the pool of money in the form of an investment. So it's a business plan competition that is teaching people how to be investors. And so again, the idea is to replicate this in your home city, to bring out the Hanoi Angel Conference or the Dakar Angel Conference or Manila or wherever. And we're here to help you do that. But we need your help to do that. So the reason we invited the investors to come today is because we can't just declare that this is going to happen. It only happens if a bunch of investors step forward to make it happen. And so we need your help to make it happen. We need you and your network and your friends to help make this possible in your city. We also need your feedback on what the right numbers are. So we think we have a good idea of what they are. We've been talking to the various organizations in these various countries to figure out what the number should be. How much should everyone write a check for in the local currency and so forth. John and I will be providing lessons not only from each other, but also from others that we know around the country and around the world to provide some background for you to help bootstrap your community's experience in investing in startups. And then you bring your friends and time to come and meet 12 weeks and we'll help you get this started. So with that, I'll open it to some questions. Oh, more people join. Lovely.
Hi, thanks for the conference. I just want to ask how much is the usual one-time investment per angel investor?
How much time or how much money?
No, I mean, how much money?
So it varies from city to city. What we do in Seattle is $5,500 per investor and aim for 40 investors. And so that's $200,000 in investment capital plus enough money to run the fund. But these numbers we're expecting to change from city to city. So in some cities, we expect that to be the US equivalent of $2,000. And in some cities, the right answer might be $10,000 because there are fewer investors, but we still need a certain amount of money. So what we need is you to sit down with your local organizations and figure out what you think the right number is.
Thanks so much.
It will also depend on the stages of the companies that are in the community and what level of work they need to do to get to the next meaningful milestone. And so if you have a lot of companies which are very, very young, you might be writing smaller checks in order to get them to a meaningful milestone.
Can I ask maybe? So
ask as many as you want.
Sorry, can I continue my question?
Please.
Can I continue my question?
Yes, please.
So is it a must that you invest as a group, like as a community of angel investor? Or is there any city that you go as individual?
So the more common format that you find in the world for angel investors is called the angel group. And in the angel group, everyone is an individual. And the format is that 2, 3, 4 companies come and present each month, once a month, 8, 9, 10, 12 times a year. And those companies are not guaranteed anything. And in fact, about half the time they walk away with nothing except the experience of pitching in front of the investors. And in that in that format, the reason we're not advocating that for your countries is, one, it's highly inefficient in terms of the fact that a lot of companies apply to pitch, only a handful get to come pitch, and then only a subset of those get investment. Everyone's acting as an individual. So it's very hard, especially at the beginning when there are few people who know how to do this, who have experience doing this. It's very hard to get people to actually write the checks, to get the investors to step forward and write the investment checks, because there's nothing, there's no urgency. There's nothing pressing for them to go and do that. So usually what happens is someone will, again, 3 companies will pitch. A few people will find some of them interesting, but then they have to organize time to do due diligence. They're busy people because angels tend to be professionals. That due diligence won't happen. The investment won't happen. The next month rolls on. They'll see another company. Maybe they'll repeat that process in the next month. In the angel conference system, in the angel accelerator system, the money is committed ahead of time. And so by saying that this pool of people are all committing to invest checks, they all write a check before this begins, there's a pool of money that will be invested, and therefore there becomes some urgency to actually invest it. That there's a milestone that's going to happen in the future that will make an investment happen. And that will attract better companies than if you just put a bunch of people in put a bunch of startups in a room full of investors who say they may invest. And it also creates a structure where the investors are committed to come and do the due diligence, and they're committed to come and talk about startups, and they're committed to make that investment, even if it's a small amount of money. And so it makes it so that the investors are more engaged and learn a lot faster how to be an investor.
So do you need to require the investor to have a committed milestone of when they're going to give the money and write a check?
Yeah, so the way this is done in Oregon and Seattle, and John's been spreading this to other cities as well, is the investors write a check in the first week or before the first week, and that check will be turned into a pool of capital that will be invested in week 12.
Yeah, we try to have the money ahead of time, at least 20 checks ahead of time before we finish the collection of startups, so that we've separated the hunting for investors from the hunting for companies.
And this is one of the distinctions between angels and funds. And this structure jumps the barrier somewhat between angels and funds. So funds have capital to invest, and they have a mandate to invest, and they have, generally a deadline. It's a pretty long deadline usually to invest, but there becomes some urgency to invest, and so it happens. And when you meet angels here in Seattle, which is a top 10 startup city in the world, when you go to an angel group, if you ask for a show of hands how many people have made an investment in the last 6 months, usually maybe 10% of the room will raise their hand. And 90% of the people will be paying money to be a member of that group and will not be actually doing any investing. They'll just be there for the fun of it, but not the actual fun part.
Yes, may I have a question, please?
Yes, go ahead.
Yeah, you said that you angel most of the time will come in groups, and they know each other before, right?
No, not usually. So the way it generally works, again, when we say groups, I'm generally speaking of angel groups. So that's a term of art, right? Angel group, capital A, capital G, angel group. Usually it's a few people who know each other to get it going, and that would be 2 or 3 people to get it going. And then using their network, they'll bring in more, and so it'll become a group of 15, and then it'll be a group of 20. And here in Seattle, we have, I think we're down to 9 angel groups.
8, actually. We just lost Wings.
Oh, okay. We're down to 8 angel groups, but they tend to be 60 to 120 investors.
Alliance of Angels is capped at 160 right now.
Okay, great.
All right.
And no, those 160 don't all know each other. Even
Okay.
now, it's a 20-year-old group. They don't know each other. 15.
It's like an online network, right?
No, these are all done in
person.
person. Usually, I'm a member of a national angel group here in the States, which means we mostly meet online. It's a big country, and we have about 500 members, but only about 150 investors. It's a complicated group, and I only know maybe 15.
Okay, thanks. And the investment ticket, and it will be equivalent to how much the angel investor will own in terms of the share of the company, right? So it will be like agreed before among the group of investor and with the company. I'm talking about the
So in the deal that the company, that the group of investors makes with the company, that can be in many different forms. But more than half of the time,
they will share the deals equally. They have the same value of the investment, right?
So we form a company that is the collection of the investors, and that company then has units. And those units, you can buy 1 or 2 units, but we don't want, we want everybody to be relatively equal. And often I recommend that regardless of how many units people buy, they still only get 1 vote, because the point is to have conversation. There is an LLC lead, a investor who is the lead investor, and they're responsible for constructing the deal with the company that is selected. And so when they invest in the company, whichever company they choose to invest in, that can be done several different ways. About half the time in Seattle, we use a convertible note. And so we don't actually know how much equity we're buying of the startup. We will know when the next financial event happens for the company, and it will convert. And then about half the time we take a preferred round that the company is already offering in some way. And we're typically seeing somewhere between 5 and 10% of the company is purchased by this company, which is the collection of all the investors. And the mechanism we use is called a limited liability company, so an LLC, or a limited corporation. And so one of the things we need to know in your context is, what's the mechanism by which a bank account is created that is owned by an entity which can then write a check? How do you create a small company or a small fund to write a check into another company? And so some simple small company mechanism needs to be outlined
with efficient tax and regulatory issues. And so we've asked the local organizations to figure that out. Right,
yeah, because at the moment in Vietnam, I think the local laws and regulations are still quite vague in terms of angel investment. So most of the time, what I see is that the individual will invest in a company that they know, they are interested in their project, or sometimes it's a group of investors, but it's still like bootstrapping rather than formal angel investors.
So one of the things that I saw
from friends and relatives.
Yeah. So one of the things I saw in Vietnam when I was there is that the people who are writing checks write checks with a very small group of friends that they know, and that there's not a broader sense of working together. And there's also a notion that I experienced of what I would call a captain of industry, where the goal was not to be a minority stakeholder in the company, but was to be essentially a partner in the company. And so as a captain of industry, they would collect up 50 or 60% of that company, and then essentially have the founding team working for them, which is a very different model than we're talking about. We're talking about minority stake in the company where there's mentoring and support, but that driving force of the company should be the CEO of the company that's invested in.
Yes, I think that in Vietnam at the moment is not the true original format of the angel investors, rather than investment in order. Most of the time they want to take over the companies or want the team to work for them. But I think personally, I'm not that type of investor, so I'm more interested in the in the true meaning of the angel investor. That's why I want to join this kind of network. But there are difficulties in Vietnam at the moment in order to do so, because even if you want to start up a fund or a small company, in order to invest in startups, I think that there's still limitations, and also people will be quite hesitant to join such a company. Yeah, but I think it's good that today we learn about this model, and we'll think about it and see how we can work in terms of setting up a small fund or small companies like that.
So I talked to several groups in Vietnam last August, including ICM and the Swiss EP folks and Bobby Liu from Founders Institute. And so there's already been several conversations in Hanoi and Da Nang around the question of deploying something like this. And I think that Swiss EP has taken the conversation to Ho Chi Minh City as well. And so it'd be worthwhile to talk to the folks there. And it's also, as I understand from Swiss EP, there is an effort by ICM to engage in this and do something relatively soon. And so I believe there's motion there already. It looks like the iAngel website is down, and so it looks like iAngel is not active anymore. And so whatever motion we did there, I don't think has been carried on. But I think that there are several other groups that are actually actively engaged in the conversation of how to create more angel investors in Vietnam.
Okay, thank you.
Okay, and I'll add to that. In addition to investing in the States, most of my investment these days is out in Africa or in other parts of the emerging market. And the models we're seeing in the States are being copied pretty much everywhere. In fact, the frontier part of this brand here, the Frontier Angel Accelerator, comes from Frontier Incubators. That is a program being funded by the Australian government to help create more accelerators in the Indo-Pacific region. So we all got together. There was 29 organizations got together last year in Singapore from, I lost track, 9 or 10 countries. And yes, there were some where the regulations were still not quite there to do this style of investing, but every single country has angel investments directly in startups in a form that does not look terribly different from what we see here in Seattle. Right? The numbers are different, the currencies are different, the percentages each buy are slightly different. But in general, there are angel investors in every country in Southeast Asia and South Asia and out into the Pacific. It's happening. So we think it's time to bring forth this model in order not only to make that happen, but to make it happen at a faster rate with more and deeper learning.
So the angel investors in your countries will not directly involved in or in any way they're involved in the management of the company, right? And how is the reporting mechanism between the companies and the investors?
It varies by company to company. But what you do, the norms are that the investors are buying what are called preferred shares. The preferred shares are shares in the company that have extra controls above and beyond the normal shares. One of those preferences, as we call them, is information rights. And so the angel investors have the right to get quarterly or biannual reports, financial reports from the company. When I do investing, I get the right to see the books of the company at any time I feel like. I get good enough reporting that I never have had to, call out that paragraph of my contract and say, you need to show me your books right now. And we tell them to send us monthly updates, and at worst, we're generally getting quarterly updates on these companies. So what's been going well, what's not been going well, what are the big changes, what are the sales, and so forth.
Yeah, got it. Thank you.
There's another question to Kiss Startup.
Yeah, I have two questions.
Okay.
One is that, so you have experience with the emerging markets. So now, do you still see the problem with the information inadequacy? Because emerging market, there's still some information that you cannot access to it.
Yeah, I'll tell you, I'm still struggling in Africa to find accountants that know how to do accounting. So as an investor, I am actually not believing the signed audited financials like I wish I could. But I get enough information from the investors that I believe like their revenue numbers and their overall profits. We can see whether or not we're making money or losing money. And, exactly where it's going, I'm never getting sufficiently accurate details on that. But we're working on solutions. One of my solutions is investing in a company that does that in Ghana.
Okay.
And trying to bring that to my other investments. But it's not terrible. I'm still getting numbers that are
not correct.
And I will tell you that anecdotally, one of my email conversations today was with a company based in New York City that has a 2-year investment in this one, has a track record of not telling me enough information as an investor. And I have conversations with American entrepreneurs trying to explain to them what's expected of them. So it's a global phenomenon of information rights. It's not an emerging market piece. It's just that accountants aren't as diligent. I don't know, aren't as accurate.
Formal, not as formal.
Oh, they're formal. That got signed audited financials, which they have to submit in some countries as part of their tax records. They're just not accurate. Yeah, happens.
Yeah, I don't think that the notion of lack of information for startups is related to the market at all. So emerging or not emerging markets, you still have not enough information to decide exactly what it is that's happening. But you can get close enough.
Yeah, and if we switch over, let's John, you've got your slide set?
Yeah, why don't you just click on the link that I posted in the slides in the chat room, and then we'll just go through the slides we did before.
Because if I make you host, then you can just switch them as you need.
All right.
Okay.
I am the host now, and so then I click on
share screen.
This first, and get into. Oh, I have, so let me get to present.
And we lost John. Now Looney will juggle for you for a few seconds here while we see if John comes back. No, John. All right, I'm going to grab the host back to me and share screen. All right, the good news for everyone else is I'm an angel investor. I'll just start in. He'll join in when he comes back. All right, so again, these are from the Seattle Angel Conference. An introduction on how to be an angel investor. All right, so the agenda here of why do angels invest, some key definitions. What we've learned from the Angel Conference is that teaching people, the key part is not only teaching people how to invest, but just teaching people this jargon that I'm trying not to use so that everybody's able to speak to each other in a nice, efficient manner. So the definitions are important. The landscape of what angel investing looks like, how to build your portfolio, because you can't just do one doesn't work. How to evaluate companies, and then any questions when John comes back here. All right, hold on a second. All right, so why do people invest? Ooh, they didn't give me a, okay, and there's no slide on that. All right, so angels invest for a few reasons. You think the reason would be just to make money, but it turns out that that's not actually the driving force for people to do angel investing. Typically what happens is there are people out there who have enough money where they have some money available to take extra risk on, right? Startup investing is a little riskier than other asset classes. And they want to use that money in order to make the world a better place. They want to use that money in order to have the fun and excitement of being part of a startup without the angst of running a startup. They want to use their experience that they have in life. Angel investors tend to be older than past middle age. So they want to use the experience they have in life and share it with others, especially professional experience. So sometimes angel investors want to dig in and be advisors to the company or at least use their connections. And in the end, they do, in fact, want to invest because they can make money doing this if they choose the right companies and make enough investments. All right, so again, the definitions are really important. So first of all, we'll start with angel investor. In the United States, it's not true that anyone can invest in a startup. Only accredited investors are allowed to invest in startups, which is shorthand version is rich people, the top 7 or 8% of the population. And an angel investor is, again, someone who's using their own money to invest in startups. And the typical instrument they're using, the typical security that they're using to make those investments is either a convertible debt note or just buying equity straight out. Priced equity is what we would call that. Now, a good angel investor, right, there's good and bad angel investors. And a good angel investor is one who can take the time to figure out how to not only make the right choices, but making the right choices is helping those startups succeed. Right, so picking the startups that are more likely to succeed and using your own knowledge and your own network to help them succeed. All right, I'm going to skip over the accredited definition because that's irrelevant to every country we're talking about in Asia. There's a distinction made out in the world of a startup versus a small business. And when John comes back, you'll discover that he and I disagree on this. A lot of the U.S.
No, we don't.
No, a little bit. Hey, welcome back.
Thank you.
You didn't have any slide on why people invest, but I filled that in. All right, so I'll let you continue on startup versus small business.
Well, the fundamental difficulty with startups is that anybody doing anything with a company that's not really a company, call it a startup. And we would like to be more precise than that. So if I'm creating a small company and that small company is going to have some notion of growth, then we would like to call it a growth company. And we would like in our startup efforts to be seeking business models that make growth companies. And we want to distinguish that from companies that are simply doing a local corner store. Now, through some mechanisms like revenue redemption, we have the opportunity to take a look at companies that might be a broader range of companies that maybe are not growing as much or as far. But without the ability to generate a change in value of the company, then it's not possible for an investment to make sense, for that actually to be an investment that returns money. So we're looking for companies that are seeking investments that will change their value in a substantial way.
All right, I'll live with that.
You want to switch to me driving it, or you can drive it? So we also want to distinguish the venture capitalists from angels, because venture capitalists typically are investing other people's money under a narrow range of conditions, and they end up making different kinds of investments, mostly because they're, in order for the economics of the fund to work for the people managing the venture capital fund, they need to write big checks. So they're writing larger checks to, therefore, older companies. And then they're aiming for these very large changes in their valuation of their company. And so they tend to focus on fewer, smaller, larger company, or sorry, fewer number, larger companies that are at later stages, which then produces a very specific outlier kind of condition. And so angel investors frequently are investing about the same amount of money in the United States as venture capital does,
in total.
but into many, many more investments. And as a result, ends up being smaller investments, many more smaller investments into many more companies. More often than not, the returns from angel investing are outpace what venture capitalists are doing. And so we get a different kind of outcome. We have, the last 3 months, had a very strange collection of things going public in the United States. So this quarter, that's not true. But most of the time, it's true that angel investing. So again, about the same amount of money, 20 to 25 billion a year is written by both venture capitalists and angels. Recently, in the last 2 or 3 years, there's been a large number of upticks in venture capital, mostly coming from essentially private equity moving down into the venture capital space. But again, we're investing in many more smaller amounts of money. When you look at the United States, it's happening everywhere, all parts of the United States. You probably are not particularly aware of all of the numbers of people in the state that we're looking at. So some of these states have very, very few people. And yet, even though there's not very many people there, we see people that are investing. The Seattle Angel Conference is now run its model in San Diego, Kelowna, and Anchorage being Anchorage, Alaska, which is not on this map, which the whole state, while it's bigger than Texas by a lot, has only 700,000 people in it. And so we know that we can run an angel conference in a community of 700,000 and have something meaningful come out of that.
The also thing to note on this map is almost a third of the capital is deployed in California. That's the state on the left.
Yes,
and not everything they do in California is applicable to anywhere else in the world, because that's more capital than was deployed in all of Europe.
Right. Yeah. So angel investors typically are looking at a lot of companies. One of the reasons that we do that is because we need to see a large number of companies to get perspective. It also is because not all the companies we see are appropriate for what we care about. And so there's a certain matching function that we need to do to find companies that do the things that we can do something useful for. Typically, there's some notion of a shortage of capital in various communities, and so some good companies won't get funded. But also, it's the case that there are companies that are perfectly good, profitable companies, but do not have a mechanism by which they will generate a return. And so it's not true that a company, just because it's profitable and growing, actually is structured in a way that you can make an investment. But it's also important to recognize that with angel returns, we're looking at companies that are in general likely to fail. 50-60% of the companies will end and have not returned any value to the investors. And so that leads us to needing to build a portfolio of some kind. And typically we're talking about a portfolio of at least 20 companies.
And I would just point out, like, what we're doing today in this part of the lesson is the big broad overview, and we'll be providing much more detail to help you understand what we mean by most will fail, and try and help you figure out which ones those are as part of the program.
So we know that there's some studies. This is from a thing by CB Insights, where they looked at 150 companies that were angel invested, and then they looked at how those companies came about to the end of whatever they did, and 50% of the time they just die. There's nothing left, it's just dead. And then sometimes we sell to a larger company, and usually that returns some money, but not always as much as we put in. Sometimes the company gets bought, but the company gets bought so that the employees of the company become employees of the other company. A good 7% of them are what we call zombies, where they're perfectly functional companies going on, not changing much, producing income for the employees, but nothing else. And so they're a perfectly good company, but they're not investable, or they shouldn't have been invested in because they never got to a milestone that changed their valuation. And so we would like to look for those companies that we can get a reasonable change in valuation, and then some mechanism by which that change in valuation returns money back to the investors. And that's a significant subset of the company. So why would we do this? Well, the answer is that the companies that succeed do not succeed in an average sort of way. They follow a power curve. And so there's a mechanism by which building a portfolio will then turn into a very reasonable rate of return that's risk adjusted. So we see from the data from a guy named Rob Wiltbank that about 25% annual return is something that they are seeing. And certainly that's true in my angel portfolio, that the angel investments that I've done in the Oregon Angel Fund have produced around 22 to 25% returns.
And anecdotally, we see the same return value in Latin America, in a bunch of middle income countries. And we don't have enough detail to know that we're going to get that in Africa, but we think we are. Right? That's our goal.
And the academic research that's been done has been validated in Northern Europe against the US, and they're about the same there as well. And so typically what we end up seeing is that most of the companies return less than what we put in. Some small number of them return something like 1 to 5x. And it's true that the ones that fail tend to fail early, and the ones that succeed tend to succeed late, but about 10% of them give better than a 10x return. And so out of that 10x return, we pay for the whole investment portfolio. And so the blue is telling us how long on average the investments were hanging around. And you can see that there's an interesting peak at 1 to 5x, that about 30% of the money that you get in return for your investment has been coming from those investments. And then a significant number has been coming from the 10x and more. And so between those two, there's two specific, I think, investment models hidden in that chart. And so,
yeah, but don't skip over the blue part. Right, the blue part is right. These things take time.
Yeah, they take time, and I don't, while the blue numbers have 3 years to 6 years, I don't personally experience those numbers. I experience much later. So the the large exits for me are coming in year 10 and year 11, and the small exits, the 1x or less than 1x, are happening in years 3 and 4.
The other takeaway from this slide, the one before it, and a bunch of the things John has said before that, here in the States, we have incredibly good statistics on startup investing. We know every investment made by venture capitalists into startups. We know a lot of the investments made by angels into startups, not all of them, but a lot. So these numbers are pretty accurate, but what we've seen over the years, because we have such great statistics, is timeframes are taking longer. So these are accurate numbers. These are like 10-year-old numbers or 13-year-old numbers.
Yeah, 2007.
But when we look at the more recent successes like Facebook and Uber versus Google, and all back to Apple in the 70s, it took Facebook 10 years to go public. Things are taking longer than it took before, and we don't have good statistics outside of the U.S. So even in Europe, they don't have great statistics. So we don't know what those timeframes are. So I would look at the blue numbers, see that it takes a long time, but don't look at the first digit. Just keep in mind that angel investing it takes a decade to understand if you did it right or not 4 or 5 years.
Right. And so one of the things about this that she's full is that you're basically involved in the people that are creating the future. And so that's very interesting. You get to learn a lot of things that you don't know otherwise. You get to help people engage in stuff that otherwise you might not even know was happening in the world. And so you can actively be part of creating the future. And so Min just asked the question, what is the role of the lead investor? And so the lead investor in our scenario is someone who is organizing all of the investors. They're responsible for helping get the deal flow and helping get the investors together. And then they're also responsible for all of the fundamental paperwork to set up the company. And we have a couple of mechanisms to help them with that. And then they negotiate the specific deal. And if they are particularly interested in the company, they maintain the relationship with that company for the life of the company. And if they're not, and the due diligence lead, who was the one that led the due diligence group for that company, might end up being the company representative, because we have like 20 or 40 angel investors and we don't want them all talking to the company all the time. That can be a little bit distracting. So we assign one person the task of being responsible for communicating between the investors and the company. So then moving on to building the portfolio. I think that you need to be in at least 20 deals for you to amortize the risk over enough opportunities so that the probability that you get this 25% return on an annual basis can occur. So we look to have people decide on a percentage of their net worth that they're willing to lose, because there is the possibility that you pick a portfolio where you get 100% loss. Typically, people are looking at somewhere between 5 and 10%. I personally have committed to 10% of my net worth into angel investing. Other people are at lower levels. I know of a few people. I know a few people who are higher. I don't know about your personal choices, but I know somebody who did the 50-50 rule. He's not particularly happy about his choice. He was a little too enthusiastic.
I'm not that risk averse, but I do more than 10%.
Right. And so when this is done in a disciplined way, then we see multiple people in the participating groups make 25% annually. So they've done some math on the size of the portfolio, and you see that if you have somewhere around 20, that the chances of you getting to a 2x return in your portfolio are up in the 90% kind of range. And if you get yourself even more, and there are certainly people who are articulating that you should be doing hundreds of investments. One of the companies in the United States doing that is called Right Side Company.
Yeah.
the venture company is doing, you know, hundreds and hundreds of company investments. That's not, I think, reasonable for somebody who's not going to be a professional fund manager. But it is reasonable for a, let's say, amateur angel investor who's doing this as a side project to set up a structure where they can get into 20 deals in a reasonable way. So we create the Seattle Angel Conference to build enough people with a community skill set who are able to do this work. And then we create something like the Seattle Angel Fund or the Oregon Angel Fund, which intentionally produces rational portfolios over a 4 to 5 year period so that the angels build this diversified portfolio of good companies.
And what we're not going to talk about tonight is the second version of the accelerator, where you write one check and it turns into 5 to 10 investments instead of one. One more thing on this slide, just in case nobody asked the question, but just in case it's not obvious, when we're talking about X's here, because usually in investments, we're talking about percentage returns. In startup investing, when you get a return, it's usually big enough that we don't do percentages, we do X's. So a 2X return means if you wrote a check of $10,000, then your return is $20,000. So twice what you put in. A 3X return would be $30,000. A 10X return would be $100,000. That's what X means.
And so there,
It depends on the time frames, right? If you're talking about the exit, it's 2X or 10X, but it depends on how long is the investment.
It depends on what price you paid per share for your shares, and it depends on what price the acquirer paid or what price the public paid for the IPO shares. And when you get down to the details, again, we'll provide more details on the details. The preferences are important as well. So whether or not you, as an investor, get your money first before everyone shares makes a difference in what the returns are going to be.
There are many variables for sure. And the notion of how long you end up holding the company and how long that process gets to for you to return something. And so in the example that's on the screen, we're basically seeing that over a different amount of time, in order for you to get a 25% IRR, a 25% annual return, for you, if it takes a very long time for that to happen, then the size of the exit that covers that has to be significantly bigger. And so you have to have a 68 multiple, 68x multiple for you to cover something over a 9-year period for you to end up with that 25% IRR.
Which does happen sometimes.
Which I have not yet had a 68, but I have had a 22. And so we see these kinds of things happen from time to time. And if you're building a large enough portfolio, the chance of them happening go up. And so typically companies in the United States don't want to take an investment less than 25,000. And so the mechanism by which we do it at the Angel Conference is to split that 25,000 up across many people. So we're doing 200,000 over 40 people, then each individual is putting in 5,000. The 5,000 is more reasonable for the early young investors, and the 200 is more than reasonable for the company. And so now we can manage that. And so we teach essentially a group investing mechanism, how a group of people can get together, build common perspective, build a mechanism by which they build a portfolio that produces reasonable returns. And also, since your goal is to help the company, to bring diverse resources to the company. And so one of the things that we discover, strangely enough, is that if you have relationships in an industry and you know about how that industry works, then the chances of that investment being a good investment go up. And that seems like common sense, but nonetheless, we can measure it.
And one more reason why groups are important, because you know something about one industry, and if you have a group of 20 people, then collectively you probably know about most of the industries.
Right. It's always interesting to see. We have a random company who's doing something quite random in a weird space, and then somebody in the room is, when I was young, I did blah, 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 and it's straight in the middle of what I have done before. And so those kinds of things are relatively regular for us. When we get a doctor in the room, the number of companies that are medically oriented that we look into deeply goes up. And so we also see that if you do due diligence, that you spend at least 20 hours digging into the guts of the company and trying to understand how it behaves, that you end up getting better results from that. There are a bunch of different ways that angel investors do angel investing. And I want to distinguish these because people sometimes lump everything together and don't understand that you get different kinds of results. And so you're seeing in Vietnam right now a bunch of lone wolves, people who invest by themselves. They tend to invest in things that they want to have significant control over. And that kind of investment happens regularly in Seattle as well. We have active angel groups where the active participation, the deal flow creation, the due diligence is done by everyone in the group. We have passive groups where the passive groups follow someone else. The typical mechanism for that is a sidecar fund where that group over there invests, and every time that Joe over there invests, then we'll invest 25,000 with them. We have angel networks like the normal angel group is a network where people gather together, select the companies, and then invest the money later. And we have online platform syndicates that drive deals between people that are remotely distributed. And then we have, excuse me, accelerator funds, things that are specific programs that have a fund associated with them. And the proposal here is to use the angel conference model as a precursor to build a fund to fund an accelerator and drive that forward. Hold on a sec.
Okay.
But it doesn't do any good to invest in random companies. There are many more companies that fail than succeed. And we have from the CB Insights guys this evaluation of the 150 companies about why things fail. And it typically comes down to they didn't talk to enough customers to know that they actually knew what subsegment cared about this enough to spend money now. They had a team that couldn't behave. They couldn't play nice together, or they didn't know what they needed to know to make things go, or they couldn't produce a product that was functional. And strangely enough, those companies already had angel investment. So if you do evaluations of these questions of, is it a good market? Is it a good team? Is there a reasonable product that meets specific needs? Then you can reduce the chances of your investment failing. But one of the reasons, a majority of the reasons that companies succeed is because they're entering the market at the right time, not too early, not too late. That's sort of hard to judge, but it's something to be aware of. Team is typically, people say we invest in team because that's actually something we can measure and try to control for. Some part of it is this interesting part of the idea. Just about as often, it's not the idea, but the way the idea is deployed in the business model. And then running at a fifth level is having enough money to do the job. And so capital is not nearly as important as getting a good team and having the right market timing. That was a good TED Talk. It's worth going and looking up that Bill Gross TED Talk. So what makes a great company? You see the market opportunity, you understand the market timing, you have a product solution fit where there are people that are excited about that solution. You have a team that's capable of working well together and can have the personal resources to drive the company forward. You have evidence that the market cares that this solution is going. That typically looks like not only revenue, but month over month growth in revenue. as a percentage growth. And then the active execution and deployment of that business process where people are actually going out and doing this work and hitting the goals that they're setting for themselves. Not everybody is clear on what the problem they're trying to solve is. They typically need to engage in that and get clear on that, and you need to understand that. You need to understand how big that is. There's often companies that come to us that have a brilliant idea that will have 100 sales total in the lifespan of the company. And it's just not a meaningful investment for us if that's true. We would like to have clarity on the size of the market, how many dollars or how much money can be spent, how many people are going to have this, is it a recurring problem, how is this problem being solved uniquely in a way that hasn't been done before, and is this the team that has the skills to make that go? Is it 3 technical guys and no salespeople? Then maybe that's not the right team. If it's, you know, a good technical person, a good marketing person, a good finance person, and a good operations person, that'll make a lot of difference. And does this solve the problem in a way that people recognize the benefit relatively quickly? So we do that kind of due diligence. When you do that due diligence and you are engaging in things, you can make reasonable amounts of returns. Only a small number of those investments are going to make those returns. So while we're working with all of the companies, some of them will not make those returns. We typically are looking at 25, 30x kinds of returns to make the portfolio work, and that can work. In markets where you don't have an acquisition mechanism, we'll need to look at other mechanisms by which the exit can take place, and that's where a conversation about revenue redemption might be a worthwhile conversation. When you do more due diligence, that due diligence can increase the probability that you pick a company that's going to succeed. And we see that working here in the United States in the Pacific Northwest. We believe that it will work in other places like Africa and Asia. We have evidence that it's working on a small scale, so now it seemed to be a good time to try and make it work on a slightly bigger scale. So I don't believe the 6 companies. I think it needs to be 20. And all of the data that you look at is fuzzy. And so take all of this with a grain of salt. Yeah, so the book that, no, go back one. So the book we typically use, it's not there.
Yeah, first one.
Oh, yeah, it is. First one, Angel Investing by David Rose, is a really useful book. It's straight down the way that I learned to do angel investing. The only thing that I quibble with in that book is the question of what you do for follow-on investing, and that's a conversation of its own. But everything else in that book, I think, is straight down the middle of what we expect to have happen. We have a group called the Angel Capital Association that does a significant amount of education and does a lot of work with our angel groups. We have, I don't know, 600 angel groups in the United States.
Yeah, 600 or 700 angel groups that are members of the ACA. It's about 25, 30,000 people total who are members of the ACA through their groups.
And I know that they're working with the folks in Europe to do training in Europe as well. And that I know that the Europeans are working with the folks in Africa to do training. So there's a bunch of these resources that are being deployed. So we can work on connecting those resources into this process as well.
Yep. All right. Any
So,
questions
and
on that? We're all still here. Awesome.
Yes.
Yeah, go ahead.
So thank you, John. And could you please share some experience about how to make the first deal happen, especially what the lead investor should do?
So for the angel conference, what we try to do is we try to get at least 20 investors to agree to be part of this deal before we get all of the companies signed up. And the way we have been doing it in other countries is we gather the first three. So we look for who's going to be the lead investor for the first angel conference, for the second angel conference, and the third angel conference. So we try to set up those people that are committed to carry the process forward for those versions. And then in their network, the probability is they have friends who want to invest or who have thought about investing or want to engage. And so we make several rings of people until we get to 20 investors. And typically in Seattle, our first investment was, we had 19. In Alaska, we had 23. In Kelowna, we had 27. So for the first round. So it's normal that it's, everybody's sort of waiting for someone else to do it first. But gathering those 20 people, at least in the United States, I argue that having 100,000 is meaningful, and it changes how people think about the company when they get $100,000. Yeah, when they get $100,000 check, then that company has succeeded in some magical way. And so the reason we get 20 people at $5,000 is to get that $100,000 number so that it moves everybody's conversation a step forward. And a company that takes $100,000 should do something meaningful with it. And so we need to figure out in your context what a meaningful number is, and then divide it by 20. Typically, it's adding a 3 to 6 month runway for the company to go do something meaningful in their milestones that they're trying to accomplish. So having gathered then the 20 investors and then publicizing that you have $100,000 that you're going to invest, you will then draw out of your community a significant number of startups that have this great idea that they want to put the $100,000 to, many of which are utterly useless. And that's part of the process. We would like those 20 investors to see the good companies, the bad companies, the too old companies, the too young companies. And out of those 20 to 40 companies that they will look at, there'll be a handful that are just right companies that are big enough to do something meaningful, not too big so that it's not something that moves things forward for them. That's got a good, high quality team with good ethics, that has personal relationships and momentum that will drive them forward, has the right attitude about how they run experiments and fail and then get back up and keep going. And so of those 2 or 3 companies, then it doesn't really matter which of the companies they invest in, because we're pretty good at picking bad companies and getting rid of them, but we're particularly bad at picking the best company. So in the 10 years of the Oregon Angel Conferences, the companies that don't make the finals are significantly worse in their performance than the companies that make the finals. But the companies that get invested in are no worse or better than the companies that make the finals. So it's sort of more evidence that we're good at finding things that will fail, but we're not so good at finding the things that will succeed, which is why we need a portfolio, so that we get enough of them that we can catch the ones that are succeeding.
Okay, all that, and what I'll add to that is to say that as soon as you get those 10, 15, 20 investors together and dangle a pool of capital, whether that's in a fund or what other mechanism we have to figure out to use to make it legal, companies will show up. So I've been running an accelerator for 7 years. I have had no problem in finding way too many companies that would like my small checks. I don't write checks of $100,000. Anecdotally, again, my next program is in Nairobi, Kenya. We're only writing checks of $3,000 to companies. We had 335 companies apply for 15 slots. And we only asked for companies from 5 different countries. So, even that 335 divided by 5, we had 67 companies per country of the target countries apply. And we'll pick 15. I've been through most of the applications already. There was like 35 or 40 that I liked that met the bar. So there's plenty of junk. There's plenty of stuff that you won't like. Doesn't matter when you dangle money in front of the ecosystem. The good entrepreneurs will show up as well as a lot of some of bad entrepreneurs.
I see.
Yeah. We talk about chickens and eggs a lot in the U.S. Right? Which comes first, chickens or eggs? There's always more startups than investors. Everywhere in the world, including California, there are more startups chasing money than there is money. The catch-22, the part of the ecosystem that gets in the way of having a city be a great startup city is capital. And so what we're proposing here is a mechanism that's proven in multiple American and Canadian cities to unlock capital and teach people how to be angel investors. And one thing John did point out in this whole thing is, so he's got 300 and something graduates.
350, yep.
350 graduates, most of which have done the program more than once. So this is a training program to teach people how to do this, and the first time through, they're done, they're graduated, they have a certificate, and they're often they're lone wolves. This is a program to teach people how to invest in groups so that they continue to invest in groups. And one of those choices that they can do the second time around is to do the conference again. And we will be introducing more variations once we get around to bring this to the Accelerator model, where each check is investing in 5 or 10 companies at once instead of one at a time. But still from a bigger pool where the quality doesn't go down.
And part of our goal is not only to teach them to invest in groups, but also to teach some of them how to be lead investors to run their own groups. And as a result of that, we have Seattle Angel Fund, now called Sea Change Fund. We have Grub Stakes, and we have Flying Fish Ventures, which all have essentially used the Angel Conference to produce the skills to then go on to form a group.
Yeah, and Flying Fish Ventures is a venture capital fund.
Yes.
So the skills learned from this program can teach people how to be venture capitalists. And that's, as much as I think we sounded negative against venture capitalists for most of our talk here, they're also necessary to make the ecosystem grow. And they show up. As soon as there are angel-funded companies, somebody steps forward and says, well, now there's an opportunity to start a venture capital fund and make more money from these companies that are further along.
Well, and I think it's worthwhile for emerging markets to mention that there's a program out of Seattle called Capria.bc, which is about the process of growing venture funds in emerging markets. And so one of the things that we would find as a mark of success is that some of the angels that go through the program would then go on to choose to become fund managers and apply to Capria.
Okay, we have 4 minutes left. Any last questions?
Hello, John. Yes, thank you for your information. I think it's very useful for me. Actually, I am now running and managing a small fund. It's a family fund, and all the investors in the fund has now about 10 investors. All of them is my friends and my family, and the industry that we choose now is investing in stock market. The point here is all the investors have money, but they do not have knowledge about investment, especially in the stock market. So they trust me, and they let me choose all the stocks to invest.
So that would be called a managed fund.
Yes.
It's one of the 5 different structures, right? Active, passive, managed, network. Yeah.
Yeah, I think the correct point is managed fund. However, I have a question. What could we do to transfer from the fund into another platform like Seattle Reference? Because all the investors, they want to invest, they have money, but they do not have knowledge. They do not have...
So knowledge is one of those things that can actually be transferred. So if they are interested in knowing, then we can put a program together where they can learn what they need to know to make that useful so that they can become good investors in whichever classification you want. But some people are just not interested in knowing that. And maybe their best mechanism for investing is to rely on some other mechanism. So passive funds and managed funds are perfectly good vehicles for a certain class of investor. But from the ecosystem point of view, your startup ecosystem, so that you produce more good public companies, you need to have more good startups that go public. So where are they coming from? Well, they come from people doing a startup idea and funding it as a not public company, right? And so depending on your market, how you go public, how you get onto the stock market, what do you do before you get onto the stock market for funding?
Yeah.
And so the answer is there needs to be people who invest in that asset class, which means you need to set up a fund of some kind. You can set up a passive fund, you can set up a managed fund, but that becomes difficult if nobody understands that asset class. And so you need to create the hundreds of people that understand it as active angel investors, which will then attract a bunch of people who are too busy to be active investors, but will like it, who then will invest passively or will invest in a managed fund.
Yeah, and what we see in the States, I don't have any stats on this, but I would say for every active angel investor, there's probably at least one, if not two, passive angel investors.
So of the 350 that have gone through our program, we have just over 150 that I can count in public that are actively continuing to write checks. And there's a bunch of those 300 that are inactive in the sense that they write checks passively to other people, and that's their entire engagement, right? Write a check and forget about it.
Yeah.
So
yeah.
Go ahead.
It means that all the fund is one angel investor. Is that right?
No. So there's a lot of different. We just touched the surface today on the complexity here. I run a fund as well.
Yeah.
So my job is running an accelerator that invests in every company that comes through its program. And so my program is funded by angel investors. I have 55 of them.
Yeah.
So they've all written checks to my fund, and I then pick the companies and write the checks to the companies. So they're all trusting me to do this. And in this case, all for private companies, all the first checks into private companies, not public companies. And then some of those, a very small number of those 55, will write follow-on investments into those companies themselves. They feel comfortable being angel investors, but the majority of my 55 investors are passive. They wrote one or two checks to me, and they're happy with that, and they're not going to write any more checks to anyone else, and they're certainly not going to do anything directly into a company. And so again, building out the ecosystem, we need to have angel investors. We need to teach people how to be fund managers. And then once there are people, hopefully we train you, and in a year you feel comfortable turning to your family and friends saying, I just had a great experience. I've done 2 rounds of this program. I made 2 investments. Do you want to join me in the 3rd one? You can come behind me. I'll pick the next one and you provide the capital, right? I'll put some of my capital at risk. You guys put even more of your capital at risk. And now we suddenly have a fund, a little angel-sized, we'd call that a seed fund, would be the term of art.
But do you think the angel size needs more times to educate investor? Maybe it's 1 year or 2 years or even longer? It's
track record. So when you have 2 or 3, or better yet, when you have 10 companies to talk about, then it becomes really easy to convince your friends and family to write a small check to create a pool of capital. When you have nothing, when you've not made one investment in this startup, and you say, I want to be an angel investor, give me some money to be a fund, or I want to be a fund manager, give me some money to be a fund, I will make investments that may look like this. That's a much harder sell. So again, my direct experience was 7 years ago today. 7 years ago last month, I had no investors. And I was telling them stories of companies that did well, but I had no stake in. And then 7 years ago this month, I had 7 companies picked out that were going to start in my program. And then 7 years come September, I had 7 graduates of my program, and I could talk about them. And with the 7 graduates, then it became much, much easier to raise money. And then I had 14 graduates, and then I had 20 and 30. Now I have 94 graduates. Now I just talk about my best companies, and new investors show up.
Yeah. Thank you. And the last question, do you think that from the other aspect, I could establish a company to manage this fund, and the company also is a startup, and
Yes.
the company could raise fund from the other investor?
There are multiple business models for doing that. And we'll talk about that in the second round of this accelerator.
Yes, thank you.
Thank you. Yes. Thanks, Looney and John. I think the companies that you just mentioned is not a startup, because you talk about the criteria of the startup is the change in valuation. And it's rather difficult to screen those startups in Vietnam for the moment. So maybe we save it for next talk.
Well, we'll definitely have within this structure, we'll be talking about alternative investment structures. Because most of what I do in Africa is not California style investing. It's what John's been calling revenue redemptions. I call it revenue-based investing. It has a lot of different names out there, but there's a style of company that's in between the little tiny store that isn't going to grow and the large tech company that may turn into a 68x. There's a whole class of companies in between, and it is possible to invest there and still make the target 20-25% annual return.
Okay, so sounds good. Yeah.
And
right.
when I was in Vietnam, I saw several entrepreneurs that had very reasonable business models that looked like they would do fine, that would be perfectly investable. And so maybe they had some little wobbly bits in their business model, but they were on point doing the right things. Both in Hanoi and Da Nang, I saw reasonable companies. So I think that Looney's idea that if there's money on the table, reasonable companies will come out is true. Right now, the question is whether or not the investment theme that you're picking aligns with what the companies have picked. That's a bigger question that's worth doing some exploration around.
Yeah, and I'll close on that just to say, right, when I said we got 335 applications for this Next African program, it was specific to five countries in Africa, basically randomly chosen by grantors. And it only is applying to companies that do regenerative agriculture, not sustainable agriculture, not fruits and vegetables, not grains, restorative agriculture, which is planting trees, bamboo, or tree-based fruits and vegetables or charcoal. Like, it's a really limited amount of companies. And yet 335 companies applied. So you dangle some money and some help to companies and they will show up. There's no shortage of companies anywhere in the world. All right, so with that, we'll let you go off to have a nice day, and we'll get some sleep down here in Seattle.
Yeah.
Thank you
Okay.
for coming.
Thanks.
Thank you.
Thanks, John. Yeah. Bye, everybody.
Bye-bye.
Thank you.
Bye. Thank you. Bye-bye.